Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will discuss this week's announcements to Canada's insured mortgage program. Also, stay tuned at the end to hear one of Tyler's dad jokes.
This week started with quite the surprise announcement by the federal government, as it was announced that they were making the boldest reforms in decades regarding Canada's mortgage system. The announcement of the two major changes was definitely surprising to everyone, as it was not expected and seemed to come out of nowhere. The first announcement was that first-time homebuyers could now qualify for 30-year amortization on an insured mortgage, whether they were buying a new build home or a resale property. This is a change from previously allowing only 25-year amortization on insured mortgages, while amending another change that came into effect August 1st that allowed first-time homebuyers to qualify for a 30-year amortization as long as they were buying a new build home. The change to allowing 30-year amortization can accomplish two things, and I will give examples shortly. The first is that it can lower monthly payments to allow first-time homebuyers to better afford their new property while getting used to home ownership. The increased cash flow can assist homebuyers with this. However, the lower payment is offset by the fact that there will be an increased interest cost to the mortgage and less principal will be paid off during the term, resulting in a higher mortgage amount at the end of it. The second thing that the increased amortization can do is increase the amount that the potential homebuyers would qualify for and potentially be able to compete for a wider range of properties that they otherwise would not have had access to. However, a budget should be considered ahead of using the program for this purpose in order not to end up housebroke. To give an example of the lower payment potential that a 30-year amortization would represent, we will use a mortgage amount of $500,000 at today's average insured rates on a 5-year fixed mortgage. The mortgage payment using 25-year amortization would be roughly $2,800 compared to the mortgage payment of roughly $2,550 using 30-year amortization. This represents a difference of $250 per month and can help make the mortgage more affordable. However, as mentioned before, the downfall to this is that there is roughly an increase of $2,000 in interest expense, and there will be roughly $16,000 less going towards principal over the term of the mortgage. This means that at the end of the term, the mortgage balance at renewal will be roughly $16,000 higher than it would have been if the 25-year amortization was used. There will likely be an increased mortgage default insurance premium to consider with the longer amortization. Details on this will follow as the insurers have time to prepare for the upcoming changes. It is important that clients consider the downfalls of using a longer amortization period and take advantage of prepayment options available to them when possible in order to ensure their mortgage is properly positioned for them in the future. It is important to note that the 30-year amortization announcement is for first-time homebuyers buying a new build or resale property, as well as anybody purchasing a new build property, whether a first-time home buyer or not. The next example is in regards to how the longer amortization period can affect how much clients would qualify for, which means they may have the opportunity to find a property that is suitable for them that may not have been an option with the current 25-year amortization. If we use annual income of $120,000 with a down payment of $40,000 and 25-year amortization, we would come up with a maximum purchase price in the range of $530,000. However, if we increase the amortization period to 30 years, the maximum purchase price could potentially increase into the neighborhood of $565,000. While this can present the opportunity of having more options available and being able to compete a bit more, it does come with the same downfalls of increased interest expense and less principal being paid over the term. It also may present the downfall of clients potentially buying more home than they can afford and struggling to make mortgage payments along with other household expenses. Before using the 30-year amortization as a way to increase purchase potential, the suitability of the program for the clients should be weighed heavily, and all negative aspects should be considered. Just because you may be able to use the increased amortization to buy more house doesn't always mean you should. The other announcement was an even bigger surprise and represented a bigger change than anyone in or out of the industry expected. Many in the mortgage industry have been advocating for an increase in the cap to purchase prices in order to have an insured mortgage. Currently, the maximum purchase price is $1 million and is sufficient in most parts of the country. However, there has been a push to increase the maximum purchase price to $1.25 million. The federal government surprised everybody and announced that the cap for an insured mortgage was being increased to $1.5 million, which is the first change to this since 2012. While this change will assist some homebuyers with being able to enter the market with a lower down payment in the more expensive parts of the country, its use may be limited as the amount of income required to qualify for such a large mortgage is out of range for most people. This may lead to an increase in cosigners being used. However, changes to tax rules regarding cosigning need to be considered first. A mortgage over $1 million with 30-year amortization for a first-time homebuyer can definitely present some big challenges, and affordability of the homebuyers themselves needs to be carefully considered, even if there are cosigners willing to assist with the purchase. The changes are proposed to take effect on December 15th of 2024, and before looking to take advantage of these programs, it is important to discuss the pros and cons with a mortgage broker beforehand. In conclusion, the government announced this week that effective later this year, amortization periods for an insured mortgage for first-time homebuyers will increase to 30 years, and the purchase price cap on an insured mortgage will increase to $1.5 million. While there are positives to these changes, they do come with offsetting downfalls that must be considered in order to ensure that you are properly prepared for the future.
In today's episode, we explain the two announcements by the federal government regarding changes to insured mortgage rules, as well as discuss the pros and cons that these changes may present. Thank you for tuning into Mortgage Foundations. And remember, every home starts with a foundation. Your mortgage should too.
Time for this week's dad joke, which I may have used once or a few hundred times myself. A caveman and a bear walk into a bar, and the bartender looks at the caveman and says, "Okay, what is your story?" The caveman looks at the bartender and says, "Bear with me.